Hello everyone. Since we don't have class today, so I'm going to go over some important concept in chapter 2 for you. The most important thing in chapter 2 is the cash flows. Now, we don't look at the statement of cash flows in this chapter, but we will look at how cash is flow within the companies. Right, for any company you can see, and let me use the pen right here. Okay, so any firm can raise capital by borrowing money from creditors, okay, and getting money from the stock holders of the companies. Okay, so once the firm receives capital from creditors and stockholders, the firms will be investing the capital into assets. Okay, now once the firm investing capital into assets, the firm will have cash flow from assets. Okay, CFFA is the cash flow from assets, and the cash flow from assets basically is the cash flow of the creditors and the cash flow of the stockholders. So therefore, CFFA will have to go back to stockholders, and CFFA will have to go back to creditors. So therefore, you have the following cash flow identity. Cash flow from assets equal to cash flow to creditors and cash flow to stockholders. So in this chapter, I will show you how to calculate the cash flow from assets and how to calculate the cash flow to creditors and cash flow to stockholders. First, cash flow from assets, it is equal to operating cash flow. Okay, the cash flow coming from operating activities, okay, and minus how much the firm spent on fixed assets. Okay, this is how much the firm spent on fixed assets, which is the net capital spending, minus changes in net working capital, which is how much the firm spent on current assets. Okay, so the cash flow from operating activities minus how much the firm spent on fixed assets minus how much the firm spent on current assets will give you the cash flow from assets. Okay, CFFA. And OCF, how do you get OCF? It is equal to earning before interest and tax plus depreciation minus taxes. How do you calculate net capital spending? Equal to the changes in the net fixed assets account plus depreciation, changes in net working capital. The formula is right here. Cash flow to creditors, cash flow to stockholders. Now, cash flow to creditors, basically it is the inflow minus the outflow. The inflow to creditors, it is the interest rate paid by the company, and the outflow to creditors is how much the creditors lend to the company during the year. Okay, and the same thing to stockholders. The inflow to the stockholders is the dividends received. Okay, dividends paid by the company, and the outflow to stockholders is how much the stockholder give the company in terms of equity during the year. Alright, so we are going to apply this concept into the example, following example. You are given the balance sheet here, okay, in 2011 and 2012. You are given the income statement in 2012. So the first question that you have is calculate the cash flow from assets. And we know that before, cash flow from assets, it is equal to the operating cash flow minus net capital spending minus changes in net working capital. So OCF, which is very simple, EBIT, you see it right here, which is 694, okay, it is 694 plus depreciation right here. See that? It is 65 minus the taxes the company paid, which is equal to 547. Now, next is net capital spending. How much the firm spent on fixed assets. If you look at the net fixed assets account, okay, I'm gonna go back to the slide over here. In 2011, the net fixed assets is 1644. In 2012, the net fixed assets is 1709. Now, if the firm did not spend anything on fixed assets, then the ending balance would be, if the firm did not spend anything on net fixed assets, and at the end of the year, it's supposed to be equal to 1644 minus 65, which is a depreciation right here. Okay, it is a depreciation of the firm. Okay, if the firm did not spend anything, the value of the assets has to go down by an amount of depreciation. So the ending balance is supposed to be 1644 minus 65 and equal to 1579. However, the ending balance is 1709. So therefore, during the year, the firm spent on fixed assets an amount equal to 1709 minus 1579 equal to 130. So 130 is the amount of money the company spent on fixed assets during the year. So from now on, to calculate how much the firm spent on net fixed assets during the year, you simply use this formula: net capital spending equal to ending net fixed assets minus beginning plus depreciation equal to 1709 minus 1644 plus 65, okay, which is depreciation. This is a ending balance, this is a beginning balance, and this is a depreciation, and the answer is 130. Okay, now, so to calculate CFFA, you need to have OCF, which is 547. You need to have net capital spending, which is equal to 130. The last thing you need is the changes in net working capital. So changes in net working capital is very simple. You calculate net working capital at the beginning of the year, and you calculate net working capital at the end of the year, and you know that net working capital, okay, net working capital is nothing but current assets minus current liability. Okay, so what is the current assets in 2011 and what is the current liability in 2011? So let's go to the slide here. Current assets in 2011 is 1112. Current liability in 2011 is 428. Okay, so go back to here. 1112 minus 428 equal to 684. In 2012, the current assets is 1403. The current liability is 389. So therefore, the net working capital in 2012 is 1403 minus 389 and equal to 1014. So the changes in net working capital is simply equal to 1014 minus 684 and equal to 330. So that is changes in net working capital. Now we can calculate, the CFFA is very easy. Is simply equal to OCF minus net capital spending minus changes, okay, in net working capital, and equal to 547, which is OCF, minus 130, which is net capital spending, minus 330, which is changes in net working capital. Okay, so the answer is equal to 87. So during the year, the firm has $87 coming from assets, and I will show you that $87 here will go back to creditors and will go back to stockholders. Now, so we calculate the cash flow to creditors. Now, cash flow to creditors equal interest rate paid, which is the inflows to the creditors, minus net new borrowing, which is outflow. Okay, how much the firm borrow from the creditors. Interest rate is $70. Let me show you the income statement right here. Okay, income statement, interest rate is 70. See that? So you put in here net new borrowing. How do you know net new borrowings? If you look at the long-term debt account in 2011 and 2012, so go back to the balance sheet. The long-term debt is 408 in 2011 and 454 in 2012. So therefore, during the year, the long-term debt increases by an amount equal to 454 minus 408 equal to 46. Now, if what it means is the company increase, okay, or borrow $46 more. So what it means is the creditors lend the company $46 during the year. So you have right here, there is this cash flow to creditors equal to interest rate, which is $70, minus net new borrowings, how much the company borrowed during the year, which is 46, and equal to 24. Very similar to cash flow to stockholders. The inflow to stockholders is the dividend, and the outflow to the stockholder is how much equity the company raised from the stockholders during the year. So the dividends amount equal to 103. Okay, how do you know 103? Go back to the income statement. See that dividends 103 right here. Okay, dividend 103. So dividend is 103. Net new equity raise. How do we know net new equity raise? We look at the common stock account. At the beginning of the year, the common stock and paid in surplus is $600. At the end of the year, it is $640. So what it means is during the year, the company raised new equity equal to $640 minus $600, and this one, this one is equal to equal to 40. So therefore the cash flow to stockholders equal to dividends, which is 103 minus net new equity raised, which is 40. So you have 103 minus 40 equal to 63. So far we have CFFA equal to 87 from before. Okay, you have CFFA equal to 87. You have cash flow to creditors equal to 24. You have cash flow to stockholders equal to 87, equal to 63. So therefore you can confirm that the cash flow from assets will be exactly equal to cash flow to creditors and the cash flow to stockholders. The second example that I will show you to just to go over what we have done so far. Okay, now you are given the followings: the current account in 2008-2009, the fixed assets in 2008 and 2009, and the depreciation expense, long-term debt and equity in 2008 and 2009, and you are given the income statement in the year 2009. Okay, so the question is the following: calculate CFFA, calculate cash flow to creditors, and calculate cash flow to stockholders. Okay, so very similar to what we did before. But remember, here you are not given the balance sheet and the income statement, so therefore you have to basically construct the balance sheet and the income statement. Okay, so for the balance sheet, you have on the left hand side you have current assets and fixed assets. So current assets in 2008 is 35.96, in 2009 it is 36.25. Net fixed assets in 2008 is 22.61, in 2009 is 21.94. So therefore you have the total assets in 08 is 58.57, and you have total assets in 09 is 58.19. Okay, now you do the same thing for the right hand side for the liabilities and equity. You have current liability in 2008 is 2140, in 2009 is 1787. Long-term debt in 2008 is 581, in 2009 is 538. Common stock and paid-in surplus capital is 372 and 462. Now we are missing retained earnings over here. Okay, so we have to calculate retained earnings. However, you know that the total liabilities and the total assets should be equal to total liabilities and equity. So you can easily get retained earnings in 2008 equal to the total assets, which is 58.57 minus the sum of all the liabilities and the other equity. So minus 2140 plus 581 plus 372, okay, plus plus 372, which is the common stock and paid-in capital, and it will be equal to 3093. Okay, so that is how you calculate retained earnings in 2008. The same thing, you calculate retained earnings in 2009. Okay, so retained earnings in 2009 is equal to total assets, which is equal to 5819 minus the sum of current liability in 2009, which is 1787, plus long-term debt, which is 538, plus common stock 462. Okay, and the answer is 3032. Alright, so that is the retained earnings in 2009. And now you have the complete balance sheet. For the income statement, it is very simple. Over here you are not given sales and cost of goods sold, but you are given earning before interest and tax, which is 1014, minus interest, which is 93, minus taxes, which is 368. You have net income equal to 553, and out of 553 you pay dividends 285, so the remaining is 268 will go to retained earnings account. Alright, so let's answer the first question. Calculate cash flow from assets. Now CFFA, we know that before, equal to OCF minus net capital spending minus changes in net working capital. So OCF equal to EBIT, which is 1014 plus depreciation 500. Okay, you can see depreciation 500 given in here. Okay, $500 minus, okay, so plus depreciation 500 minus taxes 368. So you have OCF equal to 1146. Net capital spending equal to ending net fixed assets minus beginning plus depreciation. So ending fixed assets equal to 2194, okay, minus beginning 2261 plus depreciation 500. So NCS is equal to 433. Changes in net working capital is equal to ending net working capital minus beginning net working capital. Now, so what is ending net working capital? It is equal to current assets in the year 2009 minus the current liability in the year 2009. So current assets in 2009 is 3625 minus current liability in 2009 is 1787. Okay, so that is okay, so this is net working capital in 2009. Okay, and this is a net working capital in 2008. The difference is the changes in net working capital. So the cash flow from assets equal to OCF minus net capital spending minus changes in net working capital, and the answer is $331. Now, so we go to cash flow to creditors. It is equal to interest rate paid plus net new borrowings. Interest rate is given as $93 in here. Okay, see that $93, which is the interest. Net new borrowings. Okay, how do you get net new borrowings? Okay, it is, if you look at the 2008 here, 2009 here, the long-term debt. Okay, long-term debt account in 2009 is 538. Long-term debt in 2008 is 581. So the net new borrowings would be equal to 538 minus 581 and equal to, okay, 538 minus 581 equal to negative 43. What does it mean, negative 43? It means that during the year the company, okay, paid back the principal of the debt, okay, of an amount equal to, of long-term debt, okay, of an amount equal to 43. Okay, it is, so the company paid, okay, so it goes back to the creditors. I'm sorry, this should not be the, no, it should not be a plus, it should be minus. Okay, let me, yeah, I have typo over here. Interest paid, okay, minus net new borrowing, and over here dividends minus net new equity raise. Okay, so this one is minus, not plus. This is minus. Okay, minus. Right, so the company paid back principal, so it basically $43 is an inflow to the creditors. So you can see over here it is, go back to, I have to go back to the pen. So the interest rate paid equal to, which is 93, okay, minus 43, okay, and equal to 136. So 136 is a cash flow to creditors. Very similar, you should be able to calculate cash flow to stockholders equal to dividends. How much is dividends? Dividends is equal to 285. Alright, so you have dividends equal to 285. And how much is a net new equity raise? You look at, basically look at the common stock and additional paid in capital in 2008 and 2009. Okay, in 2008 the common stock and additional paid in capital is 372. In 2009 it is 462. Okay, so you have net new equity raised is equal to ending common stock, which is 462, okay, minus beginning common stock, which is 372, okay, and equal to 0 equal to $90. Okay, net new equity raise is equal to $90. What it means is the stockholders give the company $90 during the year in the form of common stock. Now you should be able to calculate the cash flow to stockholders, which is equal to 285, okay, minus 90 equal to 195. So you have cash flow to creditors is 136, you have cash flow to stockholders, which is 195, and the sum of the two equal to 331, which is exactly equal to cash flow from assets 331 that we calculated before. Okay, so now in summary, for any company, okay, for any company you will have the cash flow from assets will be equal to cash flow to stockholders plus the cash flow to creditors. Okay, so this is probably the most important thing in chapter 2. So if you have any question, feel free to send me an email, and thank you very much.